Good evening. This is an extraordinary period for America's economy. Over the past few weeks, many Americans have felt anxiety about their finances and their future. I understand their worry and their frustration. We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed.
Having followed a worldwide recession that would last years, President Bush sent an important note to the people of the United States. This incident in 2008, as we would eventually recognize, laid the groundwork for what is widely regarded as history's biggest bubble, dubbed the everything bubble. Rather than one industry becoming gravely inflated, as was the case with the housing in 2008, we already see bubbles including almost all of single industries. Is this a sign that a greater stock market meltdown is on the way? Well, let me first welcome you to our Smart Stocks Academy channel. Don't forget to like, subscribe, and hit the notification bell next to it to be the first to know when we have a new video posted. And let's get to the video. Since the Great Recession, the S&P 500 has experienced rapid growth, with rates of return that have been parabolic in recent years. Even after this, the typical American has not reaped the benefits of this tremendous growth, and it is easy to see why. Well, it is because a majority of individuals does not invest a significant amount of their total wealth in equities. In actuality, it might be suggested that a majority of Americans have a negative wealth. As a consequence of debts or financial management, many families are living frugally, fighting to make interest charges on massively needless liabilities. The wealthy, on the other hand, has had a generation of bliss. Since 2009, the topmost 1%'s portion of total fortunes has risen from 22 to roughly 29%. This may not appear to be a huge leap, but the remarkable wet gaps issue has produced an atmosphere in which America's wealthiest families control huge chunks of the wealth stack. Here's a basic example that demonstrates how horrible this really is. As per the newest Fed stats, the upper 1% of Americans have such a combined net worth of $34 trillion, while the bottom 50% have only $2 trillion. It thus means that the higher 1% of Americans is nearly 17 times wealthier than the rest of the country. In reality, the wealth of the richest 1% is about equal to that of the poorest 90%. Since the 2008 recession, this expanding disparity has worsened dramatically, and famed investor Warren Buffett is already waving red flags in 2013, stating that good corporate results haven't translated into equivalent pay increases for the bottom 90%. Listen to this tape to hear him describe how near we were to a financial meltdown in 2008 and what the consequences were.
Business has come back very well from 5 years ago when the panic hit. And it was a panic like nobody's ever seen. I mean, whatever you think about it, it was worse. I'm dead serious about that. We were right on the edge of the cliff. And fortunately, I give enormous credit to both Ben Bernanke and Hank Paulson and Tim Geithner. And frankly, even though I didn't vote for him, never voted for him, President Bush, I don't know how many of you have studied economics, but in Adam Smith they talk about comparative advantage, and Keynes talked about animal spirits and all those people. But President Bush really came out with the great economic insight of all times, and he did it in 10 words in September of 2008. He went out there from the White House and he said, "If money doesn't loosen up, this sucker could go down." And I mean, that goes right up there. Tear down those plaques of Adam Smith. and he backed up those fellows. And so we've come back from it. But business has come back. A lot of companies are having record profits, including many of ours. And the American populace as a whole has not come back. I mean, inequality is getting wider.
The key takeaway from such footage would be that Warren credits four people for practically saving the country in 2008. Ben Bernanke, Hank Paulson, Tim Geithner, and George W. Bush. However, nearly 13 years later, since the Great Recession, many people are blaming these same individuals for all the current market difficulties. For instance, Ben Bernanke, the former chairman of the Federal Reserve, is given credit with using unconventional methods to save the country during the economic meltdown. During his leadership, the Federal Reserve dropped the risk-free rate from 5.25 to 0% in less than a year, and then produced $1.3 trillion between November of 2008 to June 2010 to acquire a variety of financial investment from banks and governments. Buffett credits this extraordinary deed with saving the country. But at what cost? Anyone with rational thinking can look at the trend of the S&P 500 and pinpoint exactly when the Federal Reserve simply took over the market, for the lack of a better term. Following Bernanke's activities, Fed chairman cited his acts as proof of how effective monetary expansion and 0% interest rates are. Consequently, in the year 2021, we have a Federal Reserve hooked to money printing. And based on current acts, we will never cease until the US dollar collapses. The infusion of dollars into the system has helped the US to retain its global economic dominance. For the past 13 years, the new cliché that stocks only move up has held true, thanks in large part to this. And the greatest perplexing aspect of this episode of events is that this approach has been effective thus far. We've basically arrived at nirvana. Despite repeated warnings from practically each economist on the globe, we print our direction out of periods of recession, and the US currency remains strong and steady. However, the actual fact stays in the consciousness of Buffett, Bernanke, and Bush. What they're trying to do is extremely daring, an act which appears to be going against every single human rationale. Some could even call it a heinous act. Our civilization has found ways of preventing, lengthening, producing, and duplicating life through numerous medical and biological developments. We have learned to win battles without killing a single soldier thanks to our military technology. We believe we have learned strategies to prevent economic downturns through our technologies and grasp of monetary and fiscal policy. Our authorities vow that everyone will flourish. The brightest individuals on the planet fight for a utopian world, and finances are an important aspect of that strategy. To me, these activities are evidence of a fading culture. The widespread view is that God was an excellent teacher, but we no longer require his services. From this moment on, we'll take control. Regrettably, history shows that this typically signals the end of a civilization. Although I don't think that the end is near, I do feel, as Charlie Munger has stated, that we have already reached our pinnacle as a dominant strength, and that our economic policies are more proof of this. While this quantitative easing method has produced excellent outcomes for the stock market, the S&P moving from 1,000 to 5,000 will have little impact on ordinary people's lives. Salaries have struggled to keep pace with company progress, and this tremendous influx of cash has propelled one small segment of American society to the peak while sinking the others. Warren explains on this same clip from 2013.
The Forbes 400, which just came out, showed aggregate wealth for the Forbes 400 of $2 trillion. You go back 20 years and that was $300 billion. So it's up 6 or 7 for one. It's different people to some extent, but this is the top. $300 billion to $2 trillion. And if you read the paper today, you would have seen that the median income, is the same place it was in terms of real purchasing power from 1989. It hasn't changed. So the inequality is getting wider. The rich are doing extremely well, extraordinarily well, and business is doing well. Business profit margins are terrific compared to the record historically. Business returns on tangible equity are terrific, but most, a great many people in our country, if you take the bottom 20% of households, that's 24 million households or something like that, housing, close to about 60 million people. It's the top level is $22,000. I don't want to try to live on $22,000 with a couple of kids. So we've got an economy that is delivering $50,000 of GDP per capita, and we've got an awful lot of people that aren't living well. So we have learned how to turn out lots of goods and services, but we haven't learned as well how to have everybody share in the bounty that we have.
Now, what would the outcome of these initiatives be? Numerous people, including Berkshire, were wary of this venture even earlier in 2013. Despite the fact that it's been roughly 8 years, everything is still moving forward. The US dollar, as previously said, continues to be secure and stable in comparison to the rest of the nation. Even a global pandemic was not enough to trigger long-term despair. Rather, the Feds decided to go all in and generate even more dollars. Ever since the Great Recession, the interest-free levels have remained zero, except for a brief period, respectively around 2016 and 2019, when the government attempted to gradually raise it. They had to send it back downwards until they could even get to 2.5%, which was everything before the epidemic. Most analysts and researchers see this period as evidence of the inescapable proof that we can't afford to support or decrease interest rates. Jay Powell, as per Peter Schiff, would much rather blow the dollar and generate inflation than reduce and wreck the economy. That's how you'll hear him talking again that the Feds is caught in between difficult choices. They've dug themselves in a grave in which their single alternative is to dig deeper, publishing more and more to fund and boost the economic bubble since the Great Recession. Warren had his misgivings even before the great study begins. While Buffett will never ever publicly admit the system's grave hazards, you can sense his skepticism in this excerpt from a speech he gave to a gathering at Georgetown University in 2013. It's a 2-minute section, but it is well worth paying attention to since it demonstrates what we already know.
Good evening. My name is James Fishback. I'm in the School of Foreign Service, first year. It's no doubt that you're an outspoken fan of Ben Bernanke, but he's going to be stepping down in January of next year. Whomever takes over the position, do you think that they should continue the Fed's controversial buyback program, and if so, for how long?
Well, I think they should take Bernanke's approach, which he says he's going to keep doing it until he sees more improvement in the economy, and I think he's been mildly disappointed not hugely disappointed, but mildly disappointed in the rate of improvement in the economy in the last few years, and therefore, just the other day, he said he's going to extend it further until he sees it. So he's not prejudging exactly when it's going to happen. He's telling you the conditions under which he'll change, and the economy is getting better. We are in an experiment which hasn't really been tried before. I mean, Fed has a $3.5 trillion balance sheet, and buying securities is usually easier than selling securities, as sometimes people find out. So we don't know how this game plays out. What will happen when they actually, if they actually try to deleverage the Fed? I mean, what has happened is the American public deleveraged and the government leveraged up through the Fed. If the Fed deleverages that in any big way, that will be a new experiment.
So what does this imply for the current economy? The S&P 500 is on the verge of hitting 5,000. And the overall trend suggests it will go much farther for more than a decade. Those who predict a market downturn has been proven wrong time and time again. Gold bugs and doomsayers have been largely shamed, and even Warren Buffett, who has been cautious to spend his vast cash reserves, has been mocked for skipping out on such big gains. It is almost impossible to anticipate when the market is going to crash, particularly in today's spiraling scenario, and it's difficult to wager against the Federal Reserve. However, that doesn't modify the foundations. Anyone who owns a world history textbook is aware of these facts. Money creation out of nothing, widening the wealth disparity, and cutting interest rates to zero is a prescription for catastrophe in the long run. At some point, this never-ending cycle of trying to kick the bucket down the road will come to a close, and the stock market will crash as a consequence. Inside the period from March 1929 to June 1932, the stock market in the United States dropped more than 90%. Traders who never traded would have to wait 25 years to cover their losses and see the dial rise just above 1929 peaks. It is likely that our grand experiment may come to an end soon, and the world will return to reality, understanding that the utopian realm of treating depressions, epidemics, and recession is unsustainable in the long run. And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, subscribe to the channel and turn on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by. We hope you enjoyed it, and we hope to see you again in our next episodes.